Good morning, good morning, good morning to everyone. It's Tim Davis here, coming to you guys with a quick market review as we approach a new month. We start a new month. Today is March the 1st, 2022. It is now about 7:03 in the morning, and I felt it very compelling and important to do a quick review as we start a new month. And I wanted to do this before my weekend review because there's a lot of things that are unfolding that I want to make sure that those folks who don't understand how price action works and how you can actually use technical analysis to track everything that's going on, even without knowing everything that's happening within our economy, within the global geopolitical tension. Technical analysis, the charts will show you everything that's unfolding and let you know which direction the market is is leaning towards as far as a continuation. Now, I want to start off real quick by pointing you guys' attention to two tools that I use as a breadth indicator of the overall movement of markets. The SPXA, well, actually three. We'll start off by showing you guys the SPXA 200-hour and point out several things and showing you how currently the moving averages are totally in control. And if you pay close, and I'm watching these moving averages on the daily charts and the weekly charts, and it's showing you the overall direction and movement of the markets. And until the moving averages are overtaken, they will remain in control. So that means if we do see rallies in the market, if they cannot overtake the 20 and the 50-day moving averages, that means any rally will rally hard. You see these hard rallies, they'll rally up to a certain point, hit the 20 or hit the 50, and then they sharply reverse. And I'm going to show you guys that it's working the same way if you use these moving averages on this tool that tracks the percentage of S&P 500 stocks that are trading above their 200-day moving average. Let me switch to a weekly chart and show you that when you get these moving average crosses, that's when you need to really pay attention to. That means the momentum in that direction is continuing to pick up steam and has not changed at all just yet. So here is this tool. And for those who've been following me for a long time, you know that I've been harping on this one, showing you guys how this percentage got to as high as 97% back in April of 2021. Since then, we've been in a steady decline. That means overall breadth of the market has been in the decline, which eventually would cause price action in the market to eventually follow, which is what's happening now, and it started following a little while ago. But look what's starting to happen right now as we speak. The momentum is starting to pick up steam. Okay, look at the crossing that we're starting to get with the 50-day crossing below the 200-day. See the highlight there? The blue line is my 50-day, the red line is my 200-day. We're starting to get a cross. The 50-day is slowly but surely trying to overtake the 200-day to the downside. That's considered a death cross in the trading world when the 50-day crosses below the 200-day. So, and that's in this breadth indicator tool. So more than likely, when you see it happen, if you see it happening here, then be prepared for it to start to happen in all of our major indices, since we are still on a downward trajectory. Okay, get that out. Now, what I'll continue to harp here is that you will see, let me give me a trend line here. You will see that since we've been in this downward trend, this yellow line that's in here is my 20-day. As we've been coming down, you can see that this yellow line has been totally been in control of price action. The 20-day has been in control of price action. I try to draw a white line over top of it to let you know every time we move back up, the candlesticks move back up towards that 20-day, look what's happening. It's getting rejected and coming right back down. It's getting rejected, coming right back down. Got a nice rejection here. And then, of course, it pushed price away from the moving averages. And you guys know how I like to continue to harp that moving averages act as price magnets. So push price away from moving averages. What happens? we're going to get a move back up towards that moving average, and look what happens, and another rejection. So that's how it's looking in this breadth indicator tool. So if the breadth indicator tool is showing this weakness and a continuation of the moving averages staying in control of price action, continuing to push price action down. So these moving averages are totally in control of price action and keeping these percentages muted. All right. So that changes every time we get these rallies. Everybody think we're in a new bull market. It's not happening until we start to get these moving averages to change directions. All right, now that's a weekly chart of this tool. And I'm gonna show you guys a quick monthly chart to show you where we stand on the monthly chart now. This is a longer term look at the monthly chart, and I told you guys that, and I highlighted a lot of areas where we could see bounces. So these two white lines in here are areas that I highlighted to show that we probably get bounces from at these levels because we've seen it in the past, dating all the way back to 2007. And each time, so far, each one of these lines act as a strong area of support, and we've gotten a bounce. As you can see, this long wick right here. Last month in February, we got a nice bounce, and look what's happening right now. I'm sorry, this should have been it probably what is this? That was in I'm sorry, January. This candlestick was in January. So we got a big pull back towards this trend line, and we got to bounce back. And now look what happened in February. Tested this lower trend line, and we got a bounce. But look where it was muted at, right around that 50%. That 50% level is a strong area of support right now on the monthly chart for this particular tool. We look back in history. Look at that recent level that we bounced from. You see a couple areas where we seem to found some support there. Right around back in 2018, got a nice rally from that level. 2016, we bounced from that level. 2011, we came below it just a little bit, bounced from that level. 2010 was a perfect bounce right off of that level. Then in 2008, we got a bounce off of the level. But what I'm paying attention to is the moving average in a big way, because the moving average is going to really show us in advance what we can expect. It looks like right now, if we look at these moving averages carefully, it looks like the 20-day on its monthly chart is ready to cross below the 50-day and the 200-day. That's going to continue to push these percentages down. So we could see even a break of this previous test, and that's right around 30 percentile. So if we get back down to right now, as of end of February, we were at 40.43, almost 44% of the S&P 500 stocks trading below their 200-day moving average. If we drop below 30%, folks, we're probably going to see this thing really wash out, and we may get all the way down to zero, as we did in previous years. The biggest one I want to pay attention to is what happened in 2008, 2009. It looks like we are slowly but surely, looks like that's possibly unfolding, that we could see a move back down to 0%, all the way down to 0% of these stocks trading below their 200-day moving average. And that would take for the Williams percentage, for the full stochastics down here that you see me trying to highlight for you guys, that would take for that Williams percentage, that full stochastics indicator to get to oversold level right here. So that would take for that to get to oversold. Already have Williams percentage down in this oversold level. And that also probably means that the RSI would dip a little further down, possibly heading down to the oversold. When we see RSI and the full stochastic, if we get to the level, both hit the oversold level, then I would be more confident that we're ready for a big time reversal. Okay. If we don't get to those oversold levels and we start to see this full stochastics indicator starting to see the green line cross back above the red line, then that'll also give me some type of inclination that we could be ready to reverse longer term. So pay close attention to that on this longer term monthly chart. Now, let me switch this back to my weekly. And we're going to dig a little bit further into we'll take a look at the VIX next. But before we look at the VIX, let's take a look. Go to my Twitter feed real quick. And again, at the beginning of my Twitter feed, I have got this from AJ Monty, who was someone who I also follow, who watches, who was a big time market analyst for Market Rebellion. Does a great job, and I pay attention to him. And I bounce a lot of my research off of him because he's right on point. Some of the same things that I've been watching and looking at. He just provides another eye. So if you haven't checked out AJ Monty on Market Rebellion, do so on YouTube. I follow him every week, and it also gives another perspective. All right, so this tool he has posted he has pinned to the front of his Twitter page, and I since did the same. This also tracks the breadth of the market. Now, we had a nice little move last week. Actually, I think the NASDAQ maybe even finished the week higher, and a continuation into yesterday, but it's like a lot of that's in the process of being undone. That's in the process of being undone. And if we pay close attention to the futures market, and also just pay close attention to these moving averages and price action, because price action is constantly being muted by these moving averages. So this tool shows you pretty much the overall breadth of the market. So when I look at this, I'm looking to see how many. This shows you the number of new highs and the number of new lows that are being created throughout the day. Sometimes you can look at this tool throughout the day, and it let you know where the breadth of the market stands. So it shows you the number of new highs and new lows for the New York Stock Exchange, which is this first tab here, and then the second one is for the NASDAQ. So as of close of business on yesterday, which was the end of the month, end of February. So on Monday, yesterday, we had the New York Stock Exchange showed showed 68 new highs, new 52-week highs, 52-week highs, not new highs, but new 52-week highs being created. If you scroll halfway down, you'll see the number of new 52-week lows, 105. So new 52-week lows is still outweighing the new 52-week highs, almost 2-to-1. Almost 2-to-1 on the New York Stock Exchange. Now, and this has been going on for quite a while, folks. I've been paying attention to this every day, each week, week in and week out. Now look at the NASDAQ. NASDAQ showed 64 new 52-week highs to close of business on 228. And scroll down, look at the number of new 52-week lows, 194. That's almost 3-to-1. So with that showing us that, and the tool that I showed you that tracks the breadth of the market as far as S&P 500 goes, it looks like there's still a negative undertones underneath the surface of this market. It looks like the pressure to the downside still remains, and the bears still seem to be in control of this overall market. We have many more new lows being created than new highs. All right, now, how's our VIX looking? And I'm gonna show you guys the VIX futures, because I've been really tracking the VIX futures for a minute, and the VIX futures is what is really showing us in advance what we can expect. So here is a weekly chart of the VIX futures, and this is one thing I've been pointing out for a minute, is I saw this pattern forming, this triangle pattern forming on the VIX future. This is a weekly chart we're looking at. As VIX price action has been rising, okay, it's been creating these higher lows along the way. And it eventually was looking for a break out of this triangle pattern as it was creating these higher lows along the way. And it looks like on a weekly chart, we're starting to see price action slowly but surely trying to sustain a move out of that triangle pattern. Now, look at the daily chart, we kind of like dropped back into that pattern over the past couple of days, but it's still intact. So here's a daily chart. Look at the daily chart of this price action, and the VIX futures got a nice pop out of that triangle back on the 24th, around the 24th of February, and then of course the bears fought back, pushed price back into that triangle. But look what it's done, folks. Look at the 20-day moving average on this. It looks just the opposite of the one that I showed you guys on the SPX 200R. The moving averages here is acting as a strong area of support. Every time price actions got back down to that 20-day on the VIX futures, it has found support and it's gotten a bounce. And now we're testing another move back above this trend line, this triangle trend line on the upside. So it looks like we are attempting to another break above this triangle trend line. And if that sustains itself throughout the day, we'll probably start to see the 20-day and 50-day start to see these moving averages starting to curl up as we go throughout the week, acting as a higher support level for price action on the VIX. All right, so that's the VIX futures. Now, let's take a look at the Dow Jones futures. All right, and this is what we'll see. You'll see that price action is being muted by the moving averages, just as they are in the SPX 200A that I showed you, 200R that I showed you. So here is our blue line, which is on top, which is our 50-day moving average. And as you can see, every time shows you that the breadth of the market is still downward, even though we're getting these little rallies here. But the moving averages have been acting as a price magnet for price action. We would get these sharp moves down, and you will see a big gap between price action and the 50-day. And then what happens, we get the nice rally back up to where? Right around that 50-day and that 20-day. Hover there for a bit before we get another move back down, creating that nice gap between price action and the moving averages. And what does it do? Price action likes to be close to the moving average. We get to move right back up. This time, look what happened this time. It's like we're getting stopped out right at the 20-day moving average. And one of the important things to pay attention to now is how we're starting to get the 20-day to cross below the 200-day of 20-day moving average is starting to cross below the 200-day moving average on this daily chart. Normally, folks, when we get those crosses, we see an acceleration to the downside. We saw one back here when we had the 20-day cross below the 50-day. We got acceleration to the downside before we found some support. So I'm looking for the same thing to happen here. We're just starting to get this crossover of the 20-day crossing below the 200-day. And it looks like we are running into resistance right there at the 20-day and the 200-day on this tool. So what I'm looking for, I don't suspect that the Dow Jones will gather up enough steam to break higher above all moving averages and create a new direction. I don't see this happening. I just don't see it. It's too much resistance over here. We got price action being muted by the 20-day, the 200-day, and the 50-day on this daily chart. So what I see happening now is a rejection right here, such as that. And we have to see what happens then. If we get a sharp rejection there, that'll probably create another gap between price action and the moving averages, then we'll probably be in store for a rally. But if we just start to see the price action start to falter, as well as the 20-day, 200-day, and the 50-day start to follow price action down, then that could be a sustainable move down until we create a big gap between price action and the moving averages. So price action and these moving averages are totally in control of everything that's happening. So this is a good way to track when we can see these rallies, when we can see these rallies get stopped out, when we can see these rallies run into resistance. The moving averages are going to continue to act as a strong area of resistance until price action finds a way to make strong rallies above these moving averages. And what I would definitely pay attention to is all 3 time frames at this point: the daily, weekly, and the monthly, because they all tell its own story. Here is let me get rid of some of these. I'm going to show you guys what the weekly chart is looking like. And that is a strong indication that price action is definitely heading downward. All right. Here's a big look, closer look at the weekly chart of the Dow Jones futures. Look what's happening. You're starting to see price action is starting to really start to falter. And look at the 20-day. See how the 20-day moving average is starting to curve downward on a weekly? That's not good for the bulls, folks. On a weekly chart, we got the 20-day moving average starting to curve downward, almost like a sphere, starting to curve downward. Okay, and look where the 50-day moving average is right now. Price action has been battling the 50-day moving average on a weekly, and it's been starting to lose. Price action is being muted, being controlled, contained below the 50-day moving average on this weekly chart. It's not good for the bulls. Okay, so if we get this crossover of the 20-day below the 50-day on the weekly, we could see a big time acceleration to the downside. So that's something to watch over the next week or so. All right, let's take a look at the NASDAQ futures. And NASDAQ futures, it looks even more defined. Look how close the 20-day moving average is to the 50-day on the NASDAQ futures on a weekly chart. If they cannot, price action cannot find a way to rally above both of these moving averages over the next week or so, look for a sharper move downward in the NASDAQ in the near term. Our daily chart of the NASDAQ, look what's happening. Look at the wins percentage. You're starting to get a curve. It's starting to come back down. The oscillators and wins percentage starting to turn downward. That's not a bullish sign. That's a bearish sign. Oscillators and the full stochastics, like they may be starting to turn back down, and the RSI may be starting to turn back down. And we have the 20-day on a daily that's starting to cross below the 200-day. That's a big time downward trajectory signal, bearish signal for the overall market in the daily chart. We have a crossover that's about to happen of the 20-day and the 50-day and the 200-day. Big time bearish signal. All right, now switching to the S&P E-minis real quick. And also here, same scenario. We have the 20-day that's starting to cross below the 200-day. That's also a big time bearish signal. And look at the oscillators and the wins percentage. Full stochastics RSI, like they're starting to turn down. So again, same scenario. If price action does not find a way to push above this 200-day and 20-day throughout the day, then it could be a big time bearish signal for the overall markets. And as far as the Russell has been struggling mightily for a minute now. And the 50-day has been acting as a strong magnet or a strong level of resistance for the Russell for a minute. Every time we get back up towards that 50-day, it has been getting pushed back down. We're back up to the 50-day again now. It looks like we are possibly going to get a rejection right there. That's our Russell. Now let's take a look at crude oil. Crude oil, folks, is finally caught up with Brent. Okay, WTI has finally caught up with Brent. That is a big that's a big deal. So Brent was over 100. Now WTI is hitting 100 in pre-market, and it looks like the bulls are looking like they want to make this sustainable. Here's a daily chart. Look at those big green candles, folks. That big green candle starting to form, pushing price action up. So still in a bullish state. So crude oil is looking strong right here. We've got to see where it takes us, folks. I don't think this is going to last forever, but for right now, crude oil is definitely extremely bullish. So we got to see where it takes us. I drew some longer term trend lines as it relates to history. So this next blue line that you see me have drawn here of a level of resistance, we hit that level back in May of 2011. We hit it in February of 2012. We hit that area around August of 2013, and we hit that area around July of 2014. So that level, which is right around close to 110 level. If we hit that 110 level, we could run into some resistance there and see a rejection. So we got to see how that pans out. And if we finally eventually break above that 110 level, folks, look what's in the cards. Almost 150 would be in the cards. If we hit that 150 level, folks, over the next year, I think we're definitely going to see a big reversal. So we have to see how that pans out, and it could be a sharp one. It could be 2008 all over again, folks. So pay close attention to what's going on with price action. Okay, take a look at gold. All right, and gold is also looking to break out of a or looking to continue a move out of a triangle pattern that I've been watching. So here is a weekly chart of gold, and I highlighted this triangle pattern a long time ago and said we would eventually break out of it, which we have done. And now it's like we're trying to continue this trend higher. Now we have the moving averages that are starting 20 days starting to pull out of this triangle area as well, and it's starting to follow price higher. So right now, the overall pattern of gold is in an uptrend, even though we had a little pullback last week. But look what's happening. We are already out of the corner, apex of that corner of that triangle. So now, just a matter of where to now. I really think that sometime this year, gold could possibly test this 2089. So pay close attention to that. Gold is in a steady uptrending pattern. Okay, and silver is also trying to continue its move higher. And on a daily chart of silver, we are starting to see a possible crossover of moving averages with this. We have the 20-day now looking to cross above the 200-day. So that is another bullish signal for metals. Last but not least, let's take a look at copper. Okay, copper is also looking to break out of a apex of a corner of a triangle. So this is what I've been really tracking next, because it's like this is the next big breakout. So here is copper. It has been hanging around this 20-day moving average on the weekly chart for a very long time. And it's like it wants to break out of this apex of this corner of this triangle. And if I had to guess, I would say we are going to break out to the upside. That is my guess. So let's see if I'm right. We got time for that to play out. All right. All right, folks, that is my current look at the markets as we head into head into March. So again, pay close attention to price action and these moving averages. If price action cannot find a way to overtake these moving averages on the daily charts, the bulls will be muted again. So, all right, folks, hopefully this helps you guys as we start the month of March. And I will catch up with you guys on my weekend market review to see how things panned out at the end of the week. Enjoy the rest of your day, folks.